All right, let's talk about coastal real estate. You know, that dream of owning a place by the sea. But what if I told you there's a secret formula, a hidden metric that tells you which properties are going to be winners and which ones are, well, not? That's what we're digging into today. Let's get started. So, here's the classic investor's dilemma. You're looking at these gorgeous beachfront places, right? And every single ad, every single sales pitch makes it sound like a guaranteed gold mine. But you know, and I know, that the reality is way messier. So how do you actually find the real gems in all that noise? And this is the real head-scratcher, isn't it? I mean, think about it. You can have two beautiful homes, maybe they're even on the same street. One is just printing money, pulling in a fantastic 14% return on investment. The other one? It's struggling just to break even. What gives? What's the secret sauce here? Well, I can tell you what it's not. It's not about the fancy marble countertops or some clever payment plan. Nope. The real answer, the key that unlocks those huge returns, isn't in any sales brochure. It's buried in the data.
Okay, so let's pull back the curtain and look at the actual formula that savvy investors use. It's this super simple but incredibly powerful tool that just cuts through all the fluff and gets straight to the point, the stuff that actually impacts your wallet.
We're calling it the Tourism Occupancy Index. And honestly, it's kind of like a cheat code for real estate. Think of it as a demand thermometer. It's a straightforward metric that measures the real strength of a rental market, telling you how likely you are to keep that property booked solid.
And here it is. Super simple, right? You just take the number of tourists a city gets every year and you multiply that by the average occupancy rate. You know, what percentage of rooms are actually full year-round. That's it. That final number gives you a clear score for that market strength.
So why should you care? Why is this index such a game changer? Well, a high score means everything you want to hear. It means you can charge higher nightly rates. It means you get stronger annual revenue. You get your money back faster, and, this is a big one, you get more stable income even in the off-season. It's pretty much the blueprint for a winning investment.
Okay, theory is great, but does this actually hold up in the real world? Let's put it to the test. We're going to do a little case study, a showdown between two of Egypt's most popular coastal markets, the Red Sea and the North Coast. Let's see what the data really says.
First up, the Red Sea. And just look at this number. We're talking over 12 million international tourists every single year. That is a massive, constant flood of people from all over the world, all looking for a place to stay 365 days a year. And here's the second piece of our formula, the occupancy rate. In a major hub like Hurghada, hotels are, on average, 65% full. And that's year-round. This isn't just a summer fling for a few months. This is a serious, long-term commitment. It signals a really stable, healthy rental market.
So, when you put those two numbers together, massive tourism and high occupancy, what do you get? This is the result. This is the payoff. In the Red Sea, investors are seeing incredible returns, anywhere from 10 to 14%. Now look at the North Coast, 2 to 4%. I mean, the difference is just staggering. The data is crystal clear here.
This chart right here tells the whole story. Let's break it down. On one side, you have the Red Sea, which is all about international tourists, all year long. On the other, the North Coast, which is almost entirely local tourism and highly seasonal. The peak season? 12 months in the Red Sea versus maybe 60, 70 days in the North Coast. It's not even a close competition. It's a totally different league.
So this really gets to the heart of why the Red Sea is so successful. Because it turns out it's not just about the number of tourists. It's about the type of tourist. Yeah, not all tourists are created equal when it comes to your ROI.
Let's look at the difference. Foreign tourism is predictable, it's year-round. These visitors tend to stay longer, and they're usually booking higher quality, more expensive places. This is what stabilizes your income, especially in the off-season. Local tourism, on the other hand, is much more seasonal, way more volatile. It's all about those short holiday peaks, and it's very price-sensitive. See the difference?
In this quote just nails it. Foreign occupancy is what stabilizes ROI because it doesn't follow the same holiday peaks as the local market. That's the whole game right there. When the local market is quiet, you've got a steady stream of international visitors filling in those gaps, keeping the cash flowing. And check this out. The demand isn't just coming from one place. You've got a really diverse mix of visitors. A huge chunk from Germany, the UK, Italy, Poland, and then a quarter from other places. What does this mean for an investor? It means stability. Your market isn't at the mercy of one country's economy.
It's incredibly resilient.
Okay, so we've cracked the code. You know the secret formula. The big question now is, how do you actually use this? Let's turn this knowledge into a practical, step-by-step plan you can use for your next investment.
All right, here's your investment checklist. 4 simple steps. Step 1, find the city's annual tourist numbers. Simple Google search. Step 2, find the average year-round occupancy rate. Step 3, figure out who the primary tourists are. Are they foreign or local? And finally, step 4, and this is the most important, make your decision by comparing the data, not the glossy marketing brochures. And if you take away just one single thing today, let it be this. A smaller apartment in a city with high, stable tourism will make you more money than a bigger, fancier apartment in a weak market. Almost every single time. It really is all about location, but location as defined by the data.
So there you have it. You've got the formula, you've got the checklist. The next time you're looking to invest, the choice is pretty clear. Are you going to get swept up in the marketing hype, or are you going to follow the data? I think you know the answer.